For 40 years, Oracle was a cash machine. Sticky database licenses, fat margins, enormous buybacks. Then it bet the house. $55.7 billion poured into data centers in a single year. Free cash flow driven deeply negative, all to chase a $638 billion backlog. And the market absolutely hated it. The stock has fallen roughly 59% from its September high, sitting almost on its 52-week low. So here is the question hanging over everything that follows. Is a proven cash compounder being thrown away at a multi-year low price? Or is the market right that this whole reinvention is a mistake? Stay to the end. By the close of this, you will know exactly where the money now flows inside Oracle, why its margins and returns on capital are sliding even as revenue accelerates, how a leveraged data center build replaced the old buyback machine, what Wall Street's forecasts actually demand, and where a fair value for the shares realistically sits today. Oracle sells the software that runs large enterprises, databases, resource planning systems, human resources applications, and the middleware knitting them together. Ripping those systems out is painful and risky, which is why they throw off cash year after year. That franchise is the foundation everything else is now being built on top of. The revenue is still overwhelmingly software. Cloud and license generated $49.2 billion in fiscal 2025, around 86% of the company. Services added $5.2 billion, and hardware, the shrinking remnant of the Sun acquisition, just $2.9 billion. This is a software business with an infrastructure business growing inside it. The acceleration is almost entirely one thing. Fourth quarter cloud infrastructure revenue jumped 93% year over year to $5.8 billion, while cloud applications grew a modest 10%, and legacy licenses actually shrank 2%. Enterprises and artificial intelligence labs renting Oracle Compute. That is the engine now. There is a catch buried in that backlog. A large share of the $638 billion remaining performance obligation rests on a handful of very large buyers, with OpenAI the most cited. The diversified software vendor of old has quietly become something closer to a project financier for a few artificial intelligence customers, whose own funding is far from certain. The top line looks superb. Revenue climbed from $42.4 billion in fiscal 2022 to $67.4 billion in fiscal 2026, about 12% compounded. But that average hides an inflection. Growth ran in single to low double digits for years, then leapt 17% in the final year as cloud infrastructure scaled. Earnings compounded even faster. Diluted earnings per share rose from $2.41 to $5.83 in 4 years, roughly 25% a year, helped by margin gains, and until recently, a steadily shrinking share count. On the surface, one of the better records in infrastructure software. The margins are where the reinvention shows its teeth. Gross margin has fallen every single year, from 79% to 65%, and the final year drop was brutal as cost of revenue jumped from $16.9 to $23.4 billion. Operating margin has held near 31%, but the direction on gross profit decides this whole case. Returns on capital tell the same cautionary story. Return on invested capital sat in a healthy 10 to 11% band for 4 years, comfortably above the cost of capital. Then it dropped to 8% because invested capital nearly doubled, from $102 to $197 billion, while operating profit grew only about 18%. The crux of the entire case is cash. Operating cash flow of $32 billion actually exceeded net income. The accounting profit is real, but capital expenditure of $55.7 billion turned that into negative $23.7 billion of free cash flow. 2 years earlier, Oracle generated $11.8 billion positive. It has gone from minting cash to burning it. Every spare dollar and many borrowed ones now flows into data centers. Capital expenditure has exploded from $4.5 billion in fiscal 2022 to $55.7 billion in fiscal 2026, 83% of revenue, with management guiding it higher still. Everything an investor pays for today is a bet on cash flows that do not yet exist. The old Oracle shrank its share count relentlessly. That is over. Buybacks collapsed from $17.3 billion in fiscal 2022 to just $206 million in fiscal 2026. And the diluted share count now rises rather than falls, from about 2.79 billion shares to 2.92 billion. Per share value creation from buybacks is gone. The dividend at least keeps growing, reaching roughly $2 a share, about 34% of net income. Comfortable against profit, against free cash flow not sustainable at all. With cash burning, every dividend dollar is currently funded by fresh debt and equity. It is safe only while capital markets stay open on reasonable terms. The balance sheet has transformed. Total debt leapt past $150 billion, and net debt now sits at 3.9 times EBITDA. High for a company whose cash generation is deteriorating, not improving. Interest is still covered about 5.3 times by operating profit, so there is no near-term solvency scare. Yet. The moat is real, but narrow. Mission-critical databases and enterprise systems are painful and dangerous to replace, which is why that software franchise sustained double-digit returns and 70% plus gross margins for years. Customers stay because leaving is a nightmare. That lock-in still protects a large, profitable core, but it is a shrinking share of the story. The growth is coming from a place where that advantage simply doesn't exist. In cloud infrastructure, Oracle holds roughly 4% of the global market, against Amazon at 28%, Microsoft at 21%, and Google at 14%. It competes on price and available chip capacity. A scale game the three giants are far better built to win. Still ahead, whether these shares are genuinely cheap or a value trap, and the single client whose stumble could break the thesis. But the backdrop matters first, and it is unkind to exactly this profile. A high beta stock has swapped self-funded cash for a leveraged back-end loaded building program and plans to raise around $40 billion more next year just as funding costs bite. The sector cycle is the defining risk. Artificial intelligence infrastructure spending is booming. Hyperscaler budgets have swelled toward roughly $700 billion. But the debate has turned to overbuild. A mid-2026 Bank for International Settlements report warned that the trillion-dollar build-out risks overcapacity if demand cools. A leveraged capacity owner is the most exposed if that proves right. Competitively, Oracle remains a distant fourth, defending prices rather than setting them, while regulatory attention to the power and financing behind the build-out is rising. Sentiment is outright capitulatory. The stock trades near its low after its worst month since 1990. And analyst targets span an extraordinary $160 to $400. Look at where the price actually sits. After peaking near $346 last September, the shares changed hands around $140, a whisker above the 52-week low of $134.57. The market has already priced in a great deal of disappointment. Valuing Oracle by discounted cash flow is awkward because free cash flow is deeply negative today and stays negative for years on management's own guidance. Nearly all the value lies in the terminal period, when, the optimists hope, spending moderates against a much larger revenue base and scale finally restores margins. That makes the answer hugely sensitive to just two assumptions: how high revenue climbs and the steady-state margin. On reported earnings, the shares now trade around 24 times, near the bottom of their recent range and well below the 30s they commanded through the build. That compression is the market's verdict in a single number. It is no longer willing to pay up for the growth Oracle is buying with all that capital. Wall Street's forecasts are aggressive. Consensus sees revenue climbing from about $67 billion to $89.5 billion next year, $130 billion the year after, and $257 billion by fiscal 2031, nearly quadrupling in 5 years, a 31% compound rate. Non-GAAP earnings per share are seen reaching almost $24. Here is the striking part. At $140, the shares trade at just 17.4 times next year's expected earnings and under 13 times the year after. The market is refusing to pay for the consensus path. It is pricing Oracle for partial failure, not for the boom. Weighing it up, forward earnings deserve more trust than a terminal-heavy discounted cash flow model, while cash is still bleeding. A leaner outcome supports roughly $110 to $130. A base case where cash flow inflects positive by fiscal 2029 supports $160 to $195. Blended fair value lands around $140 to $200, centered near $170. What would break the thesis is concrete. Another year of gross margins sliding toward the low 60s with return on invested capital stuck at or below 8% would confirm Oracle is buying revenue at value-destroying economics. If free cash flow is still deeply negative in fiscal 2028 and net debt pushes past 4.5 times EBITDA, the reinvention has failed on the numbers. The sharper danger is those few customers. Because so much of the backlog rests on a handful of counterparties, OpenAI foremost, one delay, renegotiation, or funding shortfall would show up as backlog that quietly stops converting. Cloud growth decelerating from 93% far faster than the spending commitments can be unwound. That is how a builder becomes a stranded asset problem. The upside is just as real and would arrive fast. If cloud infrastructure keeps growing near its recent pace, margins stabilize above roughly 63% as utilization rises, and free cash flow turns positive by fiscal 2029, then a stock at 13 times forward earnings looks badly mispriced, and the priced for failure story inverts into a rapid re-rating. Cheap or a mistake? On the evidence, Oracle looks fairly valued, with a modestly attractive skew for an investor who can stomach the risk. But the dispersion is enormous, and the near-term numbers get worse before they get better. The reinvention is genuine, and capitulation has left the shares pricing in an outcome materially worse than consensus expects. Against that sits the hard truth that the numbers mattering most, gross margin, returns on capital, free cash flow, are all deteriorating, and the dividend is funded by borrowing. The single biggest risk is customer concentration. If the largest artificial intelligence buyers slow their commitments, the backlog stops converting, and the leverage turns from ambitious to dangerous. This is an educational analysis, not investment advice. Everything here is for information only. Do your own research, weigh your own circumstances, and speak with a qualified financial professional before making any decision. If breaking a business down to the numbers that actually decide it is your thing, subscribe. It genuinely helps. And drop a comment with the stock you want dissected next. The best suggestions get made into full videos. Thank you very much for watching, and we'll see you next time.